This chart compares the peak gross margins of historical hardware cycles with Micron's Q3 2026 forecast. Hardware manufacturing is notoriously capital-intensive, heavily reliant on physical factories and raw materials. Because of that overhead, peak margins usually top out around 50%. Yet Micron is guiding for an 81% gross margin on $33.5 billion in revenue. That 81% projection is built on an already massive base. In Q2, the company brought in $23.86 billion, marking a 196% growth rate over the previous year. Historically, the semiconductor memory market operates as a highly cyclical commodity business. It goes through massive, extremely expensive physical build-outs, followed by brutal price crashes when the physical supply eventually outpaces the market's demand. Under the leadership of CEO Sanjay Mehrotra, Micron currently stands as the only US-based manufacturer of advanced memory. This presents a paradox. A company manufacturing physical, highly commoditized silicon wafers is suddenly dictating pricing power that rivals monopoly-level enterprise software companies. The surge in artificial intelligence compute requires massive amounts of data. The result is that memory has transitioned from a basic commodity into a scarce, tightly controlled strategic asset. Take a look at this area chart. It projects that by 2026, the data center bit TAM will cross 50% of the entire memory industry for the first time. TAM stands for Total Addressable Market, which measures the overall revenue opportunity available for a specific product if it achieved 100% market share. Artificial intelligence compute relies heavily on extending context windows, deep reasoning chains, and multi-agent orchestration. All of these processes require exponential memory scaling to function. When you analyze next-generation platforms like the NVIDIA Rubin architecture, the volume of memory required per GPU is scaling dramatically just to keep the processors fed. This 3D schematic compares a standard planar DDR5 layout against vertically stacked HBM4 cubes. HBM, or high bandwidth memory, is a specialized technology that stacks silicon dies vertically to drastically increase data transfer rates. Micron is executing massive capacity leaps here, shipping 36 GB 12 high cubes and sampling 48 GB 16 high cubes. To supply these processing clusters with data center storage requirements are also surging. This drives the rapid adoption of 122 TB PCIe Gen 6 solid-state drives. The traditional computing architecture is now inverted. Processors spend their time bottlenecked, waiting for memory. This dynamic grants memory suppliers absolute leverage in the market. To understand why suppliers cannot simply manufacture more chips to meet this surge, we have to examine the physical constraints of production. Looking at this standard silicon wafer diagram, we can observe the HBM trade ratio. This principle dictates that manufacturing one complex high-bandwidth memory die physically cannibalizes the footprint that would otherwise produce multiple standard DRAM dies. Stacking 12 or 16 of these dies vertically requires extreme packaging precision to avoid thermal degradation or total physical failure. To achieve this, the industry is transitioning to the 1 gamma node, which requires the adoption of EUV tools. EUV, or extreme ultraviolet lithography, is a highly advanced manufacturing technique that uses ultra-short light wavelengths to etch microscopic patterns onto silicon. This increased manufacturing complexity slows down physical throughput. It takes significantly more time and precision to produce these advanced nodes, leading to a net decrease in the total bits produced per wafer. Mathematically, this caps the entire industry's bit supply growth. In 2026, total DRAM supply growth is strictly limited to the low 20% range, and NAND is capped at roughly 20%. Producing high-margin AI memory actively removes standard memory capacity from the global supply chain, establishing a hard, physical floor for global pricing. The only way to escape the math of the HBM trade ratio is through massive physical greenfield expansion. Adding capacity today requires pouring millions of tons of concrete and laying miles of highly specialized cleanroom piping. Suppliers are actively expanding their global footprints. Micron recently acquired the Tongluo site in Taiwan and broke ground on a new NAND facility in Singapore. Domestically, their footprint is also expanding, with Fabs 1 and 2 under construction in Idaho, alongside early ground preparation at a greenfield site in New York. But hyper-complex fabrication plants take years to construct. The initial wafer output from these new sites will not arrive until mid-2027 or late 2028. The current AI boom is restricted by a multi-year physical choke point. The limiting factor is physical cleanroom space, not silicon design. This physical reality leads directly to a terrifying financial cost. This stepped bar chart illustrates the capital expenditure required to build these facilities. In fiscal year 2026, capital expenditures will exceed $25 billion, with construction spending alone expected to grow by over $10 billion year over year in fiscal 2027. Historically, investing $25 billion into a boom-bust commodity cycle carried massive corporate risk. To mitigate this risk, the industry introduced the Strategic Customer Agreement, or SCA. An SCA is a binding, long-term contract where a buyer commits to specific volumes and prices over multiple years. This flowchart visualizes the transition. Instead of the old model relying on one-year volume agreements, these new 5-year SCAs transfer the financial risk of building new fabrication plants directly from the memory supplier onto the hyperscaler's balance sheet. Hyperscalers are now legally obligated to underwrite the exact physical infrastructure required to sustain their own AI computing ambitions. With the data center consuming the majority of capital and cleanroom space, the broader technology ecosystem, traditional PCs, smartphones, and automotive computing, is left vulnerable. Data center demand and multi-year SCAs effectively monopolize the global supply of raw silicon wafers. As a direct result, standard PC and smartphone manufacturers are actively being starved of memory production capacity. This ecosystem map shows the supply constraints routing away from consumer devices. Current market projections indicate that this lack of memory supply will force a low double-digit decline in total PC and smartphone unit shipments for 2026. At the exact same time, new consumer devices feature agentic AI capabilities that operate locally. These systems recommend a baseline of 32 gigabytes of memory, double the standard configuration, exactly when physical supply is at its lowest. The physical toll of AI infrastructure is actively contracting traditional consumer hardware markets to sustain its own data center growth, which brings us back to the 81% gross margin. Many observers assume this margin is merely the fragile peak of a classic hardware supercycle, destined to crash once supply catches up. This graphic maps the 3 pillars preventing that crash: the mathematical ceiling of the HBM trade ratio, the massive capital expenditure moats required to build new fabs, and the guaranteed revenue locked in by 5-year strategic customer agreements. Until new greenfield fabs come fully online and reach mature yields toward the end of the decade, this tight market remains structurally locked. The underlying value of the hardware itself has shifted. Memory functions as the vital physical substrate of artificial intelligence compute. The suppliers who control its production now dictate the economics of the broader technology sector.